Good morning. Banks are tiptoeing back into CRE lending, even as old troubles stick around. So, after 2 years of tightening credit, frozen loan committees, and conservative underwriting, banks are finally stepping back into commercial real estate or CRE arena. But here's the truth investors and borrowers need to hear. Yes, banks are lending again, but no, the problems from the low rate era aren't gone quite yet. And the next 5 years will be defined by slow moving risk, not a sudden collapse, as some pundits will point out. But as a mortgage broker working directly with both investors and lenders, I'm seeing the same pattern, a lending thaw, but from a clean slate, but far from a clean slate is the way I would put that. And banks are lending again, and the thaw is real. According to Newmark, banks originated 227 billions in CRE loans the first 9 months of 2025, an 85% year-over-year surge that finally returns to somewhat normal origination levels back in 2019. And here are a few big shifts that are worth noting. Multifamily made up to 50% of quarter two originations. And office is seeing selective new financing, a sign that valuations are finally hitting the clearing levels. Now, regional banks are reopening pipelines, though with tighter DSCR and lower leverage requirements. And bridge lenders and debt funds are being outcompeted on rates again. This isn't a boom, it's simply a return to functioning credit markets, something the sector hasn't seen since early of 2022. But legacy problems still haven't gone away completely. Even though banks are lending, they're still dragging the weight of last cycle's debt. So CRE delinquencies sit at 1.56%, and that's the highest it's been since 2014. At the nation's largest banks, delinquencies have hit 1.86%. And non-performing loans continue to rise despite the lending rebound. And here's where the troubles are most concentrated in: office buildings, older multifamily buildings, hospitality in oversupplied markets, and transitional assets with stalled business plans. So analysts warn that bank stability reflects caution, not improved fundamentals. And the extend and pretend era isn't over. Banks are still relying on loan modifications and short-term extensions to avoid realizing losses. So 957 billion in CRE debt is still going to mature in 2025, and nearly half is held by banks, which means 663 billion is coming due in 2026. Banks hold 46% of that exposure, more than any other lender class. So instead of one giant maturity wall, the market now faces a rolling debt wave that's going to extend through 2030. And this is going to rewrite the entire risk timeline. Instead of a crash and then a cleanup and then a recovery cycle, we're on a slow drip, multi-year workout cycle. Macro risks in the economy are rising. While lenders are more active, macroeconomic clouds continue to darken. What we're seeing is potential rising stagflation pressures and declining consumer sentiment, but also slower job growth and some rate volatility. And recession odds are estimated anywhere between 35 to 93%, depending on the model. So really, any major shock, whether it's economic or geopolitical, could trigger forced sales, rapid repricing, and distress escalations, or even higher delinquencies. And this is why lenders are remaining conservative, even as their pipelines are reopening. And the reality is, it's a slow burn and not a sudden collapse, which is a good thing. And banks are choosing controlled workouts over forcing liquidation. And that's good news for borrowers, because that means there's going to be no fire sales or no mass foreclosures. So, in other words, no 2008 style panic. But it also means distresses will unwind slowly and not suddenly. And pricing discovery will take longer, but it seems like we're approaching normalization. And sponsors with weak balance sheets will still struggle. So borrowers with expertise or strong brokers who help them can also negotiate better terms. So here's the takeaway for the day. Banks are lending again, but they haven't resolved some of the core issues created by the low rate of the COVID era. And there could be rapid cap rate expansion and unrealistic valuations from 29 to 2022 era commercial real estate. So until something forces their hand, expect gradual workouts and conservative underwriting with rolling maturity stress tests. And opportunities are emerging deal by deal, just not market wide quite yet. So smart borrowers should act now before competition heats up, and while lenders are still offering attractive structures to strong sponsors. Now, if you need guidance on refinancing, restructuring, or sourcing new capital, the Medallion Funds team is here to help you. Please visit my website, billrapponline.com. Happy to answer any questions. There's a lot of free resources on the website. Thanks for your time. Have a good day.